Let's say China. China.
China. China.
China. China.
China.
China. China. China.
China.
China. I love them. China.
China. China. China. China. I have to have my China.
China. China. China. China. China. China. China. China. China. China. China now. China. China. You know, China.
I know China very well. China, 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 China.
People think I don't like China. I love China. China. China is the new China, by the way. China. 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 I deal with China. 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 Big league China. So don't tell me about China. I know China. China.
China. China. China. China, 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 China. I've been saying China, 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 China.
Coming up today, stocks fall hard as a trade war is back on. Another 100% in tariffs for China. Rare earth stocks respond. Crude oil nosedives. Is this a buy the dip opportunity? And what exactly is China up to, trying to cut off the West from advancing in tech? It's a massive day out there, guys. Let's go. And here we go again. The US-China Cold War heating up after it looked like it had been on the way to getting a formal agreement for months. Now it's all changed, like I'm about to show you. And so it's finally here. The long overdue pullback arrived today. Very strong rotation into safety of long-dated bonds. Something we haven't actually seen in a while, while we're getting quite the bearish breadth of the day across all risk-on sectors. Even crypto coming off hard. Gold and silver still holding up. And stick with me because later on, I'm going to show you on the charts what other ETFs are actually holding up today, along with what ETFs and sectors across the market are getting hit the hardest. As the market continues to sell off after hours as I speak, as we're getting a sharp rise in tit for tat between America and China, the S&P 500 raised over $1.5 trillion in market cap today and still sliding after hours. In fact, this was the first 2% down day since April 21st, all the way back here. Nasdaq Qs as well, off 3.5%. High beta stocks getting absolutely clobbered. The meme ETF down about 5% today, and a big spike in volatility. The fear index, the VIX, briefly getting up above 22 today, finishing up over 31%, which is a top 50 move in its entire history. In other words, today in volatility was a 1% day, as there's a big rush to safety and hedges going on out there. And so we can see the pointy end of the market, the high beta growth stocks coming off hard, with ARK Innovation, an ETF owning a few of them, down over 5.5% today. And we can often see this panic selling going into the weekend, especially on surprise news, as no one wants to hold the bag over the weekend. And since the market has been grinding higher for 6 months on low volatility, there is definitely the potential for more uncoiling next week, as there's no doubt still plenty of hot money that is accumulated in the market that could still rush to hit the exits, feeding onto itself. And so it's easy to see on this chart here, the uncoiling of this low volatility grind. We're likely going to at least go into a period of consolidation, if not a further pullback, potentially to the 200-day MA, which is around 6,050, looking on the S&P 500 index here. And if we were to get a move down there, even sharply, say next week or the next couple of weeks, that would represent about a 10% correction, which is not all that out of the ordinary. And remember, it was actually back on the 11th of May, which was a Sunday, that we got news of US and China relations cooling on the back of an informal agreement in Geneva. That's why we gapped up on Monday the 12th, above the 200-day MA, briefly came back, retested, found support, but then it's been up and to the right ever since. And so it was news of US and China cooling things that really got us back into an uptrend. So reasons to say that if fundamentally we're going back to the 9th of May, I guess it's also possible that price action can do the same. And like I said, stick with me because I'll show you the odds on Polymarket of how this could play out, along with commentary from key market players. And then I'll give you my opinion as well at the end of this video, after we've had a look at everything. And no surprise to see some of the hardest hit securities out there, like the China Large Cap ETF, off over 5% today, as they just tighten the screws on rare earths, not only adding more elements to its control list, but also tightening licensing and even reaching out to foreign use of Chinese rare earth materials and technology. Beijing's framed it as national security, with approvals expected to be denied where end users touch defense, chips, and advanced AI. And so what they're really doing is using their leverage with rare earths, directly trying to cut off the West from advancing in tech, as they're trying to overtake us and become number one in the world. And so it's yet to be seen exactly what angle China is playing here. And of course, there is a potential for relations to cool down. It still could be just a negotiation tactic as we approach the 90-day extension deadline for a trade deal to be done by November 10. And so it's no surprise to see Trump fire back, slapping on an additional 100% in tariffs over and above any tariff that they are currently paying, paired with tighter US export controls on critical software. So this definitely reopens the tariff front, signaling a broader state versus state industrial contest around compute power and materials, just like I was talking about yesterday. We're currently in the space race of the 2020s over global AI dominance. America versus China, it's that simple. As this did kind of come out of nowhere, of course there's been little tits and tats going on behind the scenes, but China really escalated it, sending letters all throughout the world, really trying to choke off America and the entire West over their grapple hold on the rare earth critical minerals industry. And the timing is a little interesting. The day after a peace deal was brokered in Israel. But there is still good chance that the two leaders could meet later on this month on the sidelines of APEC, Asian Economic Summit in South Korea. No doubt the odds have dropped significantly today, but this can be a bit of a playbook from the president. Come out swinging and then dial it back, also responding to markets if need be as well. And this could also just be a negotiation tactic from the Chinese as well. But it's a good reminder for us investors that surprise news and volatility is a normal and expected part of markets and trading. Being able to stomach it is key to long-term success, not getting caught up in the moment. It also reinforces the importance of not using leverage and remaining well diversified. And that's because volatility is the toll we pay to invest. In fact, there's 3% dips on an average year in the stock market. We also get more than 5% dips. Most years, we'll see a 10% correction. Then we can see sizable corrections every 3 or 4 years. In fact, we already saw a 30% pullback in the Russell 2000 earlier this year. If we're on the cusp of another one, that would be a little unusual, but no doubt possible, as it looks like this current low volatility grinding streak is now over. 33 days we went without a 1% up or down day. And like I said, it's completely uncoiled, but looking back in history, these periods of low volatility can quite often cluster. We saw that in the late 2010s and the 90s as well. We can get those pullbacks and corrections, then just as quickly things can stabilize and start grinding again. And we did just have one of the best V-shaped recoveries ever. On some measures, one of the best and most smoothest bounces back after a sell-off in the market, going almost 120 days without a 3% pullback. So we were well overdue. And like I've been saying, for some reason, we always seem to get surprise volatility events in the month of October, like we're getting right now. Why that is could be complete randomness, or maybe there's some sort of universal cycle going on. But for some reason, Octobers can get quite dicey, even within bull markets. As we're getting a little bit of a rug pull, just as bullish sentiment started improving again. Like I said yesterday, the biggest spread between bullish and bearish sentiment we'd seen in a while. Now the market's quickly back to the bottom of the fear zone, 29 here. Very well on the verge of going into extreme fear. Like I said, technically, there's definitely more room to sell off. Looking on my S&P oscillator, currently at 44.5. Has to go below 40 for the market to be technically oversold. And the last time we saw that back in the tariff tantrum lows. So unless we get a quick pivot or bit of backdoor communication between American and Chinese governments, maybe issuing some temporary waivers, I don't think both sides want to get into a nasty and prolonged trade war. It could very well just be posturing going into final negotiations. But that being said, just based on market dynamics and positioning, we very well could find support around 6,400, which would still be a minor pullback overall. And we very well could get the third down October in a row, something we haven't seen since the late 70s. And this meme here sums it up pretty well. Trump saying China made a sinister move with rare earth controls, many new countermeasures and tariffs under consideration, be forced to financially counter China's move. And just like this guy's expression, I'm sure that's what a lot of us are feeling today. Like, oh boy, here we go again. We thought we're all past this. Not so much. Hopefully this doesn't drag on for too much longer, because according to Polymarket, there is still a 73% chance we will get a US-China tariff agreement by November 10th. Obviously that's dropped a lot from this morning at 93%, but still a lot better than 50-50. And so we'll be keeping an eye on these odds for an indication that things are still moving ahead. It just may be a short-lived tit for tat going into negotiations, and if so, could very well prove to be a buy the dip opportunity. But if these big tariffs stick, then I think we could sell off a bit further. It all kind of depends on the next couple of weeks, whether things are able to cool down and they're able to work out a deal. Because even though China has leverage with rare earths, really important going forward, they still rely on selling America $500 billion worth of goods each year, along with important American tech as well. So America no doubt still has a lot of leverage, but it's no surprise to see rare earth stocks climb today, a theme that's been going on in the market already for a few months. Because rare earths already play a key role in many important technologies, like smartphones, wind turbines, light bulbs, electric vehicles, fiber optics, and China has a grapple on this market, which they're now using against us. And so in my mind, it makes Companies like Idaho Strategic Resources, which own the largest rare earth deposits in the states, are more likely to get a Trump deal now. It should be all hands on deck, going at max speed to deleverage from China and take away their ability for us to slow down our advancement in tech as they're trying to take the lead in the world. Really strong price action in the state's largest rare earth miner, MP Materials, also finishing the day up, and others as well, like Energy Fuels, continuing to trade higher here. And China didn't stop with rare earths. They also going tit for tat on port fee, and they're going to start charging US ships for docking at Chinese ports. Also just targeting one of America's largest chip makers, heavily exposed to China, Qualcomm, now under investigation by China's market regulator for allegedly violating anti-monopoly law. And obviously the market didn't like that one bit at all, with the stock off over 7% today. And the entire semi-industry down hard, almost 6% on heavy selling, as it's very much exposed to China. We even saw a massive dump in crude oil on the prospect of slower global growth, actually taking out multi-month support today, off sharply, now back into the 50s per barrel, which kind of works to counteract any slower growth. It just makes the cost of growth cheaper, the cost of travel and moving goods cheaper. So overall, that's not really a bad thing at all. And the US Treasury's already indicated to the market they are standing by, ready to take action if need be, reportedly preparing emergency measures to ensure financial market stability. Specific details have not yet been disclosed. No doubt there's some high-level closed-door meetings taking place, ready to step in at a moment's notice to try and contain any spillover. And that was really the best performing asset class today. Long dated treasury bonds, big move up. We haven't seen that kind of rotation for a while. And you know it's not directly related to yields pulling back because we didn't see a rally across the entire bond complex, because high yield bonds actually sold off today in a definitive risk off environment. And so the question is this the top for this current multi-year bull market? Is it the top for the 15-year secular bull market? Is it a 10% correction, or is it just a tiny 3-5% pullback? Are the underlying fundamentals still driving this bull market intact? What does the potential risk of a nasty US-China trade war do to the AI boom? Could tail risks come into play? Potentially something to do with Taiwan, where much of the West still heavily relies on for chip production. We can't deleverage from there quick enough. Well, according to Dan Ives, they're buyers of this tech sell-off, saying this is just a white-knuckle moment for the markets with tech stocks under major pressure today. They continue to believe the bark will be likely worse than bite and cooler heads will prevail. It's all a game of high-stakes poker going on between the US and China in this AI revolution, as we're also seeing more scrutiny in Beijing around Nvidia's golden chips. Going on to say we've barely scratched the surface of this fourth industrial revolution, now playing out around the world, being led by big American tech, which they think will finish strong into the year, up another 7%. And this moment's more like 1996, not 1999. Quite bullish. Same with Tom Lee. Said it's a buy the dip opportunity. S&P could be 60 points higher a week from now. And so no doubt the fundamentals are still there. We're seeing it day after day. 10% of the world's adult population now using GPT, and the growth in the usage of AI way faster than internet adoption. It took the internet 13 years to reach 800 million users. GPT is set to do that in less than 3. It's been simply incredible, the growth in AI. They simply can't get enough compute power and electricity to meet the demand that they have. So even in the worst case of a prolonged and nasty US-China trade war, does that affect it? Well, it doesn't affect the demand, but it can very much affect the supply side of the equation with chips and other equipment used to generate power. And China's influence on a lot of industries out there, like lithium and batteries. Hence why we're seeing the lit ETF coming off hard today, almost 9%, even further after hours. And so no doubt we're seeing a bit of a pullback in our portfolios today. A lot of these hot themes getting sold off. But like I always say, volatility is part of the game. And if the downtrends persist, we'll naturally rotate into what is working out there. Ethereum off 8% today. And just looking at the crypto Bitcoin itself, trading live here, has bounced a little bit, did briefly get down to 109,000. Massive drop from just yesterday, trading at 123. Super volatile out there. And of course, with Chinese securities, like the Chinese internet ETF, KWEB, and Chinese stocks Alibaba. The tail risk for them is still, if the trade war gets nasty, they could potentially get delisted from American exchanges, is a big source of exposure and capital for Chinese companies. The real tail risk is with Taiwan, with that ETF, EWT, also coming off 5% today. But it's really semiconductors that are needed for that AI boom, really sensitive to any fresh curbs or actions China wants to tighten things even further, and no surprise to see the AI trade come off somewhat today, along with some of these hot stocks like iron, putting in a big bearish engulfing candle. I'd be surprised if we don't consolidate for a few weeks here, if not pull back to some moving averages, because we'd really need a quick and fast pivot from both sides to kind of relieve the pressure in the market now that things have kind of uncoiled, and we can see that with high beta ETF losing its 50-day MA, which goes hand in hand with momentum, the technology momentum ETF, off almost 6% today, along with some pretty big bearish reversal candles across the board, looking at the digital transformation ETF, crypto related. No surprise to see super hot quantum stocks coming off as well. Solar, still very much exposed to China, and even other sectors you wouldn't think would come off hard today did, like the regional banks, down 4.5%, and energy sectors as well. In line with the fall in crude oil, coming off hard, but it was really long-dated government bond ETFs, the best performing out there today, along with gold and silver holding up somewhat, but they didn't go up more than bonds. Junior gold miners still holding on there, and interestingly enough, the Vietnam ETF finishing high today as they do have large rare earth deposits the US is now more likely to make a deal with. They're already trying to turn to Vietnam for more manufacturing to continue deleveraging from China, so we very well could see a deal with Vietnam, maybe even as soon as next week, as the admin seeks to gain some leverage in this situation going into the November 10 deadline for a formal trade deal. But regardless of the fundamentals, the technicals look pretty heavy here, as we've had a really good recovery and run up. We were always going to get some sort of surprise and headline to uncoil it. Very well could come down, test the lower bands, even potentially down to the 200-day MA over the next week or two. Modern day markets can correct quite sharply, and we can get those volatility episodes that can kind of come out of nowhere. But typically, looking back in history, whenever the VIX spikes above 25 and 30, especially the higher it goes in a spike, pretty much all the time they prove to be good buying opportunity, buying into max fear, as a lot of people get shaken out. Traders and funds that are leveraged get margin called, but a froth comes out of the system, and those that can stomach it usually end up winning. But I am seeing a lot of people across my X feed today saying this is a buy the dip opportunity. In addition to Dan Ives and Tom Lee, I would say that's the overwhelming consensus, that this is already a buy the dip, which would be surprising if so many people called for it, and we did just dip on Monday. Looking at the options market, they're pricing in a potentially spicy Monday, but a backwardation with the VIX one day over 25.7, which very well means we could get a 2% day on Monday, either up or down. And just looking at some breadth measures like the percentage stocks above the 20-day average at 27%, still has further room to fall before we see a real kind of flush out. They can often get down to single digits as we get that widespread selling, and you can see that in the sector breadth as well. Typically, we're closer to a short-term low when all the sectors are red and on low single digits or even zero. That is percent of stocks above the 5-day MA. So there's still room for a flush out, and we can see that in my S&P oscillator, but no doubt a sharp pullback up the front, along with a spike in volatility. I think 6,400 would be a fair target. Would be surprising to see a new deal between US and China come Monday or Tuesday. Could be positive developments next week, but it could also dial up even further. So we should be prepared for that. But again, this is part and parcel of trading and investing. Not the first time, it won't be the last time. Just remember to stick to your strategy, focus on the long term. Don't get too caught up in the moment, and there's more to life than trading. So try and close the screens over the weekend, get some fresh air, and see the forest for the trees. That's all for this week on the Daily Market Review. Thanks for sticking with Click Capital, and no doubt next week will be a big, interesting one. I'm excited to get in there and break it all down for you guys. Once again, come Monday night. Cheers.